Okay, this week we're going to cover Chapter 10. And Chapter 10 is all about budgeting, the basics of budgeting and the planning of budgeting and how management uses a budget to plan, to help their planning. It's a planning tool. We looked in Chapter 1 when we introduced what management accounting was. We discovered that one of the major responsibilities of management is planning. And planning is the idea that the management establishes objectives for the whole company. They have to have short-term objectives, they have to have long-term objectives. And a budget is really the formal statement, the written statement of management. So this chapter takes a look at budgets, takes a look at what they are, the benefits of budgeting, the different components of the budget. We're going to look at how you actually budget and prepare a budgeted income statement and balance sheet, and we'll also look at a budgeted cash budget. Lots of you have seen the cash budget already because you saw that in finance class, but we're going to take a look at it again from a little bit of a different angle. So, what is a budget? How do we define it? Really, it's a formal written statement, right? It's what management intends to happen. It's long term or short term, but it's formalized. It's written down so that everybody can take a look at it, everybody can see um, what the plans are, right? It's based on past history, it's based on the research that of what's going to happen in the future within that economy or within that industry, and it's based hopefully on realistic goals, right? And one of the things we'll talk about is that budgets have to be realistic, otherwise they don't become a good planning tool. They become a tool which works to the detriment of the company. And also, what a budget does is that it communicates to all levels in the organization about what the plans are, right? A budget is something that everybody in the organization has to work towards. All levels of management are involved, hopefully, in the creation of the budget, and so they agree on where they're headed. And so, one of the benefits of that is that it really promotes efficiency, right? It promotes them working together. It promotes the company working together, management working together, all different levels of management working together toward this common goal of meeting the budget or attaining the budget. One of the keys to a good budget is that top management accepts it, right? It's kind of one of the essentials. If top management accepts the budget and is for the budget and shows that they are really supportive of the budget, that gets communicated down to all levels, and there's that authority and responsibility behind it. So you really need a good, sound, solid organizational structure behind this budget. Once you've got a good budget in place, management will use that budget as an evaluation tool, as a reflection, to reflect back on how it went. Was the budget attained? Why not? If it wasn't, different areas that were improved on. And so it is an important basis for performance evaluation. And sometimes management will be compensated, or parts of their compensation will come from, an evaluation of how they actually did against what they were budgeted to do. So and the last point there is it's to help management, right? It's not in substitution of management. It's to help management. Um, so management is responsible for the budget, and they're responsible for promoting the budget, being behind the budget. But they have to be actively involved. So where does accounting come in? Well, really, part of a budget is about numbers. Right? So the accounting information makes major contributions to this budgeting process. Um, from the accounting is based on past, right? So the actual accounting records is based on historical data, and we know that because we record things as they happen. So when we're reporting the numbers, they're based on past history. But we have past history. We have historical data for revenues. We have historical data for different costs, for different expenses, right? And all of these items are required when we're putting together a budget. Now, a budget is presented for the future. So we have to remember that when we're taking a look at the past, right? So we look at the past information, we put it together, and then we start to plan ahead. Okay, so, but history can tell us a lot about what will happen in the future. So we look at trends, we look at, we look at not only accounting and the historical data within the company, but we will also look at data within the economy, within the industry, and we'll put that together too as we're formulating our future plans. Now, the accountants are typically responsible for presenting the goals in financial terms, right? All that is a way of saying that we put the numbers to it. So management says, here's my goal, and we associate a number. And we need help doing that, right? Because accountants aren't necessarily the people that are going to say, well, this is what our sales will be. That would really fall into the sales department or the sales category. The salespeople, they would kind of project what future sales are going to be, the pricing of that. But accountants actually put it all together, right? They take the pieces from the sales department, they take the pieces from, whoever's going to cost the product, and they put the pieces all together to present it in this consolidated budget so that the whole company can see what the goals are in these financial terms. Okay, again, it's just kind of noted there, and I talked about it briefly before. The budget is management's responsibility. Okay, it is their responsibility to make sure the budget is accurate. It's their responsibility to be behind the budget, support the budget, the administration of the budget, the tracking to the budget. Budget is management's responsibility. All right, what are the benefits of budgeting? We've talked about a few of them as I've been kind of introducing what budgeting is. But really, it does involve, because it involves all levels of management, it actually requires management and encourages them to be planning ahead, formalizing goals, and to reassess and do that on a continual basis so that they're always planning ahead, right? If we don't plan ahead, we don't necessarily know where we're headed. So budgeting helps us determine where we're headed as a company, where we want to go, and then how we're going to actually get there. It gives a way to evaluate performance. So it helps define those objectives in order to establish how to evaluate performance for different levels of management or for different levels of responsibility. It lets you know, as you're assessing the budget of actual to budget, it lets you know whether there's any problems, right? Are your sales way off, or are your costs way off? And what does that mean? Will that impact the profitability of the company? So it acts as an early warning sign. It acts as an early warning signal to give indication of potential problems that may be occurring. It means that it can motivate, or the budget can actually motivate everybody in the company if it's attainable. And so we'll talk a little bit about that. If it's an effective budget, an attainable budget, or one that motivates managers or motivates the employees to try to attain, then it becomes very useful, right? The budgeting tool, the budget, can become very useful if it's attainable and if it motivates people throughout that organization to meet the planned objectives, to get where they're trying to head. It has to be effective. In order to be effective, it has to be accepted by everybody, has to be realistic, and it has to be supported by upper management. So what length of budget period is acceptable? In reality, it can be any length of time, right? It could be 2 months, it could be 3 months, it could be 6 months, it could be a year, it can be 5 years, it can be longer than that. The most common length of time is 1 year. And that's most common because typically that's the fiscal period. Right? A fiscal period is 12 months, typically, is 12 months long. So most budgets will budget out for the next 12 months. Occasionally they do what we would call a continuous 12-month budget. And that is just as 1 month passes, you drop a month and you pick up the next month. So it's a continual budget. You're just keeping management planning for that full 12 months. So you're not looking at the next 12 months and then as a month goes by, now you're only looking at 11. You're always looking at 12 months ahead. Now we'll start with a year. Typically, we start with that year, a budget for 1 year period of time, and then we add to it, and we do quarterly budgets, and we do monthly budgets, and that will help all levels of management, again, or all employees, know where they are and how to attain the budget. So it's broken down into manageable chunks, right? So this month we're looking at this month's sales. Next month we're looking at that month of sales. One of the other reasons that we look at 12 months is because 12 months normally takes care of any cyclical or seasonal activities. So, for example, if you have a business that does a lot more, or a company that does a lot more business during the summertime, 12 months will cover the summertime and will cover the winter, fall and springtime. So you're covering all seasons. So you're hopefully, it's long enough that you're covering all of the fluctuations that a business typically will go through during a year. We want it not to be too long in that we can't provide or have realistic estimates or reliable estimates. Remember, the farther you plan out, the more unknown. It's easier to plan sales for next month than it is to plan sales for 6 months from now or a year from now. So a year is typically short enough that you can get some reliable, realistic estimates based on past history and based on the trends that you see happening in the marketplace. So those are some of the things that you want to remember when you're taking a look at the length of a budgeting period. So that typically when we do the 1 year, we will break that down into monthly and quarterly. And it is just kind of important to know that different budgets, and when we say different budgets, we're going to look in a few minutes at all of the different budgets, because we have sales budgets, we have manufacturing overhead budgets, we have direct labor budgets, we have direct materials budgets, selling and administrative budgets. We can create the budgets on different time periods. It makes things a little bit more complicated as we're walking through this stuff, but it can be done. Okay, so that's the kind of the length of the budget period that we're looking at. How do we base the budget? Well, like I said, just before we get to the budgeting process, what we do is we base the budget on past performance, right? We collect our data, we collect the historical data from all of the different organizational units, from all of the different departments, and we begin this process before the start of the next year. If we're doing 1 year at a time, we begin a couple months in advance. It takes a while to accumulate all the information, to get it all together, to get the numbers to it, and get it down in a formalized budget. And then typically what you'll find happening in a company is once the budget is prepared, or it's prepared and then it's reviewed, and then it may be changed a little bit before it actually is formally adopted and accepted. Okay. Now we really develop the budget within the framework of a sales forecast, right? That really drives everything. And the reason is because, of course, how much we sell will drive a lot of our costs, our product costs for sure, because depending on how much we sell will depend on how much product we need to make in a manufacturing company, or how much product we need to have available. So the sales forecast is very important. And our sales forecast, what it does is it shows what we think the industry sales will be and what our company's expected share will be. So we look specifically at what our company is expected to sell in the coming, length of period of time that we're actually looking at budgeting. Right? So if it's 12 months, we're looking at what is our sales forecasted for the next 12 months. What do we consider? Right? Lots of things that we have to consider. Take a look at the economy. Right? If we're in a housing market, we're selling houses, real estate, and the economy is in a downturn, it may impact the number of sales we expect to have. Right? If the economy is in a boom, there seems to be lots of spendable money, and we're in the vacation industry, we're going to forecast lots of sales. So when we're talking about sales forecasting, we're looking at what are the economic conditions that are out there. What's the economy doing? What's the projection for the economy? Are analysts predicting that we're going into more of a boom time? Are they predicting that our economy is going to slow down? What are they predicting? What are the trends? What are the industry trends? So we look at the economy as a whole. You think of it as a big full umbrella, right? Like every business is under this economy. And then within that, we look at the different industries. What industry are we in? How does our industry do historically within the economy that is predicted over the next little bit of time? So we're looking at research studies. We're taking a look at what do we anticipate happening with regards to advertising and promotion. Are we headed into a period of time where we're advertising a lot? Um, or we've got something specific. Maybe this year we were advertising in the Super Bowl. And so we expect a lot of sales to happen out of that. Right, so we're taking a look at that. We're looking at what our market share was before. We're taking a look at, is there any new players in the market? Is there any new competition, or is there any competition that maybe doesn't exist anymore? What do we anticipate our market share to be going forward? What about pricing, right? Do we need to change our pricing, or do we anticipate a change in pricing to remain competitive? You know, what do we expect to have happen with regards to how much we're selling our product for? And also technological developments, right? What's happening in technology? Are we going to put in some new technology, some new computers that will reduce the amount of labor costs that we have? You know, are we in the technology industry? Because as we know, technology continually is updating and continually improving. So what kind of developments do we expect in the next month or 2 months or 6 months or the next year? Because that will impact our sales. Okay, so our sales forecasting really drives our budgets. And so when we're considering our sales forecasting, we're looking at all of this stuff. And so you'll notice that not all of this stuff is based on the accounting department, right? We're not getting all this from the accounting department. We might get what the market share is. Maybe the accounting department has some stats on that. But we're not getting a lot of this information from accounting. So accounting is part of the process, but it's not the full process. In smaller companies, all companies do budgeting. Whether you're small or whether you're medium sized or whether you're large, all companies are doing budgeting. In smaller companies, it's a little bit more informal, right? Some of the management may sit down and kind of put together this budget that they want to try to attain to, but it's more informal because it's just not as large a company. There's not that many people there, so you can do it on a more informal basis. Everybody can agree to it, and you can move forward. In a larger company, you'll typically have what we call budget committees, and the budget committees get together and they look at the budget, right? And a budget committee would consist, you can see there, of the president, treasurer, the controller, and management from each major area. So what major areas are we talking about? The sales area, you know, maybe payroll, promotion, all of the different major departments, plant operator, you know, they're all there talking about what their costs are expected to be. They're talking about what, you know, their revenues are expected to be. So everybody's represented. And they get together and they review the budget. They try to prepare the budget, and managers will defend what their goals are, what their requests are. And what that's getting at is that with a budget, sometimes they'll say, you know what, we need to budget for an extra couple $100,000, and the question will be, okay, why? Where is that couple $100,000 going to come from? Is somebody else going to give it up? Or do we need to find a couple more $100,000 in sales to be able to support the additional cost? Right? So when you're looking at budgeting as a whole, when you're looking at a big company, if you think about it in terms of, you know, you have this large company, you may have somebody that's involved or oversees the physical building, the physical structure. So in their budget, they may have costs including utilities. They may have costs including repairs and maintenance. Right? They may have costs for overhauls from machinery. Right? And they would have to look at what's their budget. Okay, Well, typically I budget for so much for utilities, so much for, repairs and maintenance, but this year I've got a large maintenance item we have to budget for. Or maybe I've got a budget for a large expenditure, a capital expenditure, because it's time. One of our machines is really old. Then I might have another department who looks after personnel, and they say, okay, we need to budget to hire some new people, right? So I need more money to be able to hire more people. We may have somebody responsible for advertising, and they may say, we want to do a really large advertising campaign because we've got a new product and we really want to push this product. And so we need more money. So each department kind of defends what their budget is and what they want. Um, and then, decisions have to be made from the committee as a whole as to who's going to get additional money and who maybe is not. Maybe that capital expenditure has to wait a year. Maybe we have to wait a little bit before we hire a new person. Or maybe there's some adjusting that has to be done. Maybe we need to compromise a little bit. So in larger companies, it's a big process. And that's why, when I mentioned earlier, it starts a couple months, before, just because it takes a long time to get there. The ideal is that every level of management or every level is involved in the setting of the budget. Um, so that it's what we call participative budgeting, which we'll look at in a second. Okay, and I mentioned this before. A budget is a planning tool, and it can be very effective, and it can be motivational. But it can also be discouraging. So it's kind of a fine line, really. And you'll work in companies. You'll see companies where the budgets work really well, and they help the company. And you'll also run into companies where budgets are not used very well, and they're not motivating at all. They're actually discouraging, and it's actually like a dismotivation. I don't guess that's not a word, but it actually really works the opposite of motivating them. So it depends, right? It really depends on how the budget is developed and how the budget is administered. So if all levels of management or all levels of the company are involved in setting the budget, then they feel a little bit more ownership in it. If you think about it from a personal point of view, if you're, thinking about what you want to do this weekend, and you know that you have to talk to your friends or your family, and together you make a plan for what's going to happen on the weekend. If that happens, you're much more likely to be okay with the plan because you had some say in it. Whereas if, your friends say, this is what we're doing this at 8 o'clock, and this at 10 o'clock, and this at 1 o'clock, and this at 4 o'clock, and this is how it's happening, you may not buy into it as much. Depends, right? It depends on what you want. But you don't buy into the process as much because you weren't part of it. You were told what to do. And that's kind of just human behavior. We don't really like to be told what to do. We like to be involved, and we like to think that we have a say. So participative management really is called bottom up or bottom to top, right? It's a bottom to top approach. And what it does is it really involves um, everybody. Okay? Sorry, I've gone a little bit too ahead here. Let me go back. Okay. The bottom to top approach involves everybody. It means that everybody participates in the setting of the budget. A couple of advantages here. Really, the people that are the lower management have more knowledge about what happens on a day-to-day basis. They have more detailed knowledge of their area, so it really results in more accurate budgets. It also gives the perception, right, that everybody's involved, everybody's participating, everybody's setting the budget. It's your budget, so it gives a sense of ownership. So the goal of this kind of participative budgeting is to produce this budget that's considered fair and achievable while still trying to maintain the corporate goals. So what you'll find in large companies is that the corporation or corporate will send down goals to their divisions or their individual companies, which will push those divisions to earn more profit. Usually it's all about the bottom line. So they push them, they increase their sales a bit. What you don't want to have happen is you don't want all your management to set budgets that are just so easy to attain that there's no drive to make the company more efficient or more effective or more profitable, right? So we want to create realistic budgets that also push the company a little bit to be more effective, to be more efficient, to be more profitable. Okay, so it's a kind of a delicate balance in creating this participative budgeting. Now, of course, participative budgeting, if you're involving all levels of management or all levels in the company, you can imagine that it can be quite time consuming. And time is money. So it can be quite time consuming and quite costly. And also you can have what you call this kind of game going on. So different levels of management do this game and they have produced budgetary slack. And what that means is they are intentionally understating or underestimating what their revenue will be and perhaps overestimating what their expenses is. And what that does, it makes it easier to attain their goals. And remember we said that sometimes budgets are used as a method of evaluation, right? So if you have this budgetary slack idea going on where we don't forecast out as we underestimate our forecasted sales, then when we look back, we've done really well compared to budget. So it is a delicate balance. The whole idea behind budgeting is a delicate balance of producing a realistic budget that I already mentioned, pushes the company a little bit to be more efficient, to be more effective, and to be more profitable. So it's tough. But the budgeting process is very important. And so in every company that you go to, they'll have a different process and they will have a different perception. The employees will have a different perception of the budget. But do know that one of the biggest things is having buy-in of the whole company. If you have buy-in of the people in the company to the budget, they will use the budget as a tool to try to they will use the budget as a tool and it'll be an effective tool. If the budget is unrealistic, then employees are not motivated and they become very discouraged. So it's just a delicate balance of finding how to create that budget properly. So, and that is, as I mentioned before, that is management's responsibility. Budgets can also be, and we'll take a look at this. What you're seeing here is the master budget. Budgets can be very, very detailed. So they can be very detailed and should be very detailed, right? Because they should kind of lay out what are my forecasts, what are my sales forecasts, what are my costs being forecasted as. So we've used some different terms. We talk about budgeting and we talk about long-range planning. Budgeting is really, like I said, just usually a year, usually 12 months. So it's relatively short term, right? We learn that in financial accounting that under a year is short term and over a year is long term. So our emphasis in the budget is short term goals. It doesn't mean that management shouldn't be looking at long range stuff, right? It doesn't mean that they shouldn't be looking at the 5-year goal or the 10-year goal. They should still be looking at that. But we tend to call that long range planning. Okay, so when we're talking about long range planning, we're talking about, the 5 years out, 10 years out. Where do we want to be 5 years or 10 years or 15 years from now? It's long-term goals, long-term strategies, policies and plans to kind of get those strategies, implement those strategies, get them in place so you can get where you want to be down the road in the future. So it's not as detailed, right? You can't be as detailed when you're talking 5 years out as you can be when you're talking within the next 12 months. Okay, so the master budget that you can see in front of you, you can see this will be new or should be relatively new to most of you. We've kind of dealt with, or you will have seen dealt with in finance, the cash budget, which is right there at the very bottom in the middle, the cash budget. And we've looked at a cash budget, cash in versus cash out. And if you go back to your recollection of the cash budget, we talked about how the sales impact that. But really, it's a lot more complicated than that. So you can see the master budget itself includes all of these individual components, all of these interrelated budgets. Um, and they're split into what we call operating budgets and financial budgets. The operational or the operating budgets, you can see start with the sales budget, which I mentioned before. Everything kind of is triggered with the sales budget because depending on how much we think we'll sell, will depend on how much we produce. So as you walk through this, right, we figure out what we're going to sell, which dictates what we're going to need to produce. What we need to produce will dictate how much direct materials we need. Obviously, how much materials do we need for that production, level of production, how much labor we need for that level of production, how much overhead we need. And that's, so those three budgets, those three product costs that we learned about way back in chapter 2, the direct materials, direct labor, and the overhead come out of that production budget. So we start with our sales budget, we work down to our production budget, into our three different product costs, and then we also have to look at our selling and admin budget. Right, so if you again remember back to chapter 2 when we looked at the definition of cost, we had our product costs and we had our period costs. So our product costs, direct materials, direct labor, and overhead. Our period costs being the selling and admin budget. Once we have those budgets, those operating budgets together, we can then create our budgeted income statement. And really, that's what our operating budgets do. Our operating budgets are these little individual, maybe not little, but these individual budgets that will result in the preparation of our budgeted income statement. Right? Those operational budgets establish the goals for the sales, right? With the sales budget, we're establishing the goals for the sales department, the sales personnel, and then the production budget, direct materials, direct labor, and overhead budgets. Those are producing the goals or establishing the goals for the production personnel. They're putting into place what will need to be produced in order to meet the sales budget. So they're interrelated. They're interrelated individual budgets that help establish the goals for the sales and for the production personnel. Okay, the financial budgets, your financial budgets are what we probably would be used to. It's our balance sheet, the cash budget, the capital expenditure budget. And the capital expenditure budget, you'll notice, is kind of separate. Because capital expenditure budget is that budget which tells us what is the capital that we're going to need to purchase and when are we going to need to purchase it. Like, are we going to need a new building? Are we going to need new machinery? Are we going to need new equipment? What are we going to need, and when do we plan on purchasing it? So you can notice when you're looking at the master budget and the components of it, all of our operating budgets drill down into our income statement. Our income statement, of course, will go into our cash budget, right? It will establish our cash budget. And then our balance sheet and our capital expenditure kind of sit on their own. But these financial budgets, their goal is to focus really on cash. What is the cash that we need to fund our operations, to fund our capital expenditures? What's the cash we need? And as we've learned, and as you've learned in your other courses, cash is important. Right? We do all of our accounting based on accrual accounting, but cash is what pays the bills. So we need to know about our cash. And so our financial budgets really focus on cash and what are our cash needs in order to fund our operations, in order to fund our capital expenditures. So what we're going to do is we're going to work our way through each of these budgets and how we prepare each of these budgets. We'll start at the top. We'll start with our sales budget. Okay, so let's start with the sales budget. The first budget we prepare is a sales budget. The sales budget, as I've mentioned, kind of drives the other budgets. So we first of all have to figure out what our sales forecast is. So sales forecast, again, we talked about it's based on lots of different factors: market share, economic circumstances, industry trends, anticipated promotion or advertising, technological development, all sorts of different things. But it's management's best estimate of what the sales will be for the budget period. Okay, so typically for a year, or maybe for the quarter. And when we talked about the budget being done for a year, I said lots of times it's done also in segments, right? So you do it for a year and then you break it down to monthly or you break it down to quarterly. So the example that we're going to walk through actually has it for the year, and then we break it down into a per quarter sales forecast or sales budget. So every other budget depends on the sales budget. And really it's prepared fairly simply by just taking your expected sales volume for each product and multiplying it by the anticipated unit selling price. So here's an example: sales budget based on the expected sales volume. It's telling you 3,000 units in each quarter, the first quarter, with 500 unit increments each following quarter. So that means 3,000 in quarter one, 3,500 in quarter two, 4,000 in quarter three, and 4,500 units in quarter four. And we multiply it by the unit selling price. So as you can see here, we've got our sales budget for quarter one is 180,000, for quarter two, 210,000, quarter three, 240,000, quarter four, 270,000. So for a total for the year, for the 12 months, of 900,000, with our total number of expected units and our unit selling price. Notice how the expected unit sales doesn't have to be the same each quarter, right? The sales don't have to be expected to take place uniformly throughout the year. They can take place at different levels throughout the year. So in this case, we've continually gone up. You may have budgets where, quarter one is really high and quarter two is really low. For example, if you're looking at a cyclical company where, sales in the summer are much higher than the sales in the winter, or opposite, right? Sales in the winter much higher than sales in the summer. So sales budget drives the other budgets. All of the other budgets are based on the sales budget, or depends on the sales budget. So the first thing we always produce is the sales budget. The next thing we produce, of course, is the production budget. And that budget is based on how much do we need to produce in order to meet the sales demand or the anticipated sales. So you take the sales budget, figure out what you want in ending inventory, and that determines how much you need to make. Okay, and the reason ending inventory is important is because you need to have the appropriate amount of ending inventory, because your ending inventory becomes your opening or your beginning inventory. You have to have enough inventory to go into the next quarter or the next year, right? To go into the next period. The idea is that if I have too much ending inventory, excessive ending inventory, then I may have to cut back my production in the next period, right? Or I may have to cut back laborers in the next period. If I don't have enough ending inventory to go into the next period, I may end up with a shortfall, right? A shortage of inventory for people who want to come and buy it. And that might result in lost sales, or it might result in me having to pay overtime for people to work more, to produce more, so that I have the inventory there for the sales as they come in. So it is important to figure out what my ending inventory needs to be. So what you do in the formula, the required production for formula, or the formula for required production, is just taking your desired number of sales units. So how much do I need to sell? Adding the desired amount of ending inventory. How much do I want at the end of the period and subtracting off what I'm starting with, right? So we're using that kind of that age-old formula, our beginning inventory plus what we purchased or what we put into production minus our ending inventory is the goods that we have available for sale. So we're just using that and massaging that formula a little bit. We want to know how many units do we need to sell, plus the number of units that we want in ending inventory, right? Those two numbers added together give me the total number of units, the total number of units that I need to sell and have on hand at the end. I subtract what I start with, and that will give me the units that I need to produce. Right? The units that I need to produce will be the difference between the units I need to sell, plus the units I need to have on hand at the end, minus the units I start with. Okay, so it has to give us a little bit of information. And so, of course, the units we need to sell comes from sales budget. And so we had seen in this example, 3,000 unit sales in the first quarter. You can see on the first line there, 3,000 unit sales in the first quarter, 3,500 unit sales in the second quarter, 4,000 unit sales in the third quarter, and 4,500 units sales in the fourth quarter. And then I add in, right, see my formula down the side here, what I want to sell, what I expect to sell, what I want to end with, my finished goods, gives me the total number of required units. I subtract off what I started with, and I get what I need to produce. So, what do I need to end with? And so this information would have to be given to you in the question. It's given to you at the top of the slide there. Hayes Company believes it can meet future sales needs with an ending inventory of 20% of next quarter's sales. Okay, so the quarter one ending inventory, so 700 units there, is 20% of quarter two sales. So 3,500 units, quarter two, I want 20% of that on hand at the end of quarter one, meaning that that will be my opening inventory in quarter two. So it's 700 units, 3,500 times 20%. In quarter two, my ending inventory I want it to be 20% of the estimated or anticipated sales of quarter three. So 4,000 units in quarter three is my anticipated sales. Multiplied by 20% is the 800 desired ending inventory. I do that for each quarter. Okay, so now notice in quarter four, my ending inventory is 20% of the quarter one from the next year. So I also would need that information, right? And if I continued on with 500 units increase every quarter, and quarter one of the next year, my units expected sales would be 5,000 units. So 20% of that is 1,000. So that's where that number is coming from. So I add up my expected unit sales and my expected or desired ending inventory for each quarter, and that gives me the total required units for the quarter. I then subtract off the beginning finished goods, and I end up with the required production. Okay, the required production is giving me what I will need to produce this quarter. Okay, so my ending inventory from quarter one becomes my beginning inventory for quarter two. My ending inventory for quarter two becomes my beginning inventory for quarter three. My ending inventory for quarter three becomes my beginning inventory for quarter four. My beginning inventory in quarter one would have been my ending inventory in the previous quarter, quarter four, which would have been 20% of the 3,000, right? Following along with what they've been doing the whole time. So I get my required number of units that I need to produce. And you can see there it's broken down by quarter, and it doesn't continually go up. I have 3,100 units I need to produce in the first quarter, 3,600 in the second quarter, 4,100 in the third quarter, 4,600 in the fourth quarter. So, the units are actually, the number of units I need to produce are gradually increasing as we go along from quarter to quarter. So my sales budget drives my production budget. My production budget is then going to drive the individual product cost budgets, which are my direct materials budget, my direct labor budget, and my manufacturing overhead budget. So let's start with my direct materials budget. My direct materials budget is going to show me how much materials I need to buy. Right? Direct materials, of course, raw materials. What do I need to purchase? What do I need to buy? So the direct materials budget shows the cost and the quantity of what I need to purchase. Notice in our production budget, actually, if you revisit our sales budget is in dollars, right? Number of sales units times dollar per unit gives us a dollar amount. Our production budget was only in units. There was no cost associated with it. So if we went back to our production budget for a second, you notice only in units. How many units need to be produced? No dollars are attached here. In our direct materials budget, we want to know, we're going to actually attach dollars to it, right? We want to know how much how much direct materials do I need to produce and how much is it going to cost me? So to do the direct materials budget, I got to take a look at the production budget. What do I need to produce? And then I need to know how much material do I need for each product that I want to produce. I'm using the same formula, basically. I take the units that I need to produce. I add in what my ending inventory should be for direct materials. That's going to give me, the total amount of direct materials that I need, the total materials required. I subtract out my beginning direct materials, and this is all in units, right? And what I will end up with is the required amount that I need to purchase, the required direct material units that I need to purchase. I can then multiply that amount by the cost per unit and get a budgeted cost of direct materials. So let's see how that works. Here's our example. You notice again that the units to be produced, 3,100 in quarter one, 3,600 in quarter two, 4,100 in quarter three, and 4,600 in quarter four, these all come from my production budget, right? What do I need to be produced? They come from my production budget. The next number here is going to have to be a given. It would be information that would be given to you in the question. But what management has to do is they have to determine how much of direct materials do they need for each unit. So here it's telling you 2, right? The direct materials required for each unit is 2. It might be 2, in this case it's kilograms, so it could be kilograms or in a weight or in a different measuring system. But here it's 2 kilograms per unit. So the total number of kilograms that I need in order to produce what I need to produce is the number of units to be produced times 2. Right, so 3,100 times 2, I need 6,200 kilograms of direct materials to produce what I need to produce in quarter one. I need 7,200 kilograms of direct materials for quarter 2. And so on. Okay? I subtract off my beginning inventory, or what I want in my direct materials inventory, to get what I need to purchase, which makes sense, right? I need to know what amount of direct materials I need in order to complete the production I need to complete. I need to include the amount that I need to complete the ending inventory. Not to complete it, but I need to include the amount of direct materials I want in ending inventory so that next quarter I can start production with some of the direct materials that are already there. And then I take away what I started with. Okay. Now, again, we need some information, right? So we need to know the amount per unit. So in this case, it would have told us 2 kilograms a unit. Also, we need to know what is our desired ending inventory. How much ending inventory do we need for raw materials? For direct materials. In this case, we need, and it tells us down in the footnote, we need 10% of next quarter's production requirements. So, in quarter 2, I need 10% of 7,200. quarter two's production units is 7,200. So in the quarter one ending inventory for direct materials is 10% of that. In quarter two, my ending inventory is going to be 10% of what I need to produce in quarter three, or what I need for production in quarter three. So 8,200 times 10%, and so on. Okay. So that's how I determine my ending inventory. Of course, my ending inventory for one quarter becomes my beginning inventory of the next quarter. How did I determine my beginning inventory in quarter one? Well, it would have been the ending inventory from the previous quarter, which would have been 10% of the 6,200. So it would have been 620 kilograms. So I take the total units or the total kilograms I need for production. I subtract out my beginning inventory, and I come up with the number of direct materials I need to purchase. Okay, so I need to purchase direct materials of 6,300 in quarter one, 7,300 in quarter two, 8,300 in quarter three, and 9,300 in quarter four. Right, and of course that's in kilograms. So 6,300 kilograms in quarter one. I then put the cost to it. What's the cost? This is an estimated number based on what we think the cost, in this case, per kilogram will be. And they're estimating $4 a kilogram. So my total cost direct materials is the number of kilograms I need to purchase times the cost per kilogram. And you can see it there, 6,300 times 4 for 25,200 in quarter one. And we do that for each quarter, and for the year, we have total cost direct materials purchased of 124,800. That's the first product cost budget, the direct materials. Next, we have to take a look at direct labor. Now, direct labor doesn't have a beginning inventory and an ending inventory, right? We don't inventory direct labor. So with the direct labor budget, all we need to really do is figure out how many hours are going to be worked and what the cost of it is. Right, and of course, we're taking into consideration what we need to produce. So how many hours need to be worked in order to produce what needs to be produced? And it's critical. This budget is kind of critical in that we need to make sure that we have the proper amount of workforce on hand. Right, we need to maintain that labor or that workforce to meet the expected production. So you can see the formula there. Units to be produced times the direct labor time per unit times the cost per hour is going to give me my direct labor cost. Let's take a look at it. So again, we're going back to our production budget. How much needs to be produced? Well, you can see there the top line is the number of units that need to be produced in each quarter. 3,100, 3,600, 4,100, 4,600 in each quarter, multiplied by the number of hours per unit. Now in this case, just don't get confused here. This 2 seems to be the same, or is the same number as the 2 in direct materials, but they're not meant to be always the same, right? The direct materials was 2 kilograms per unit. This is 2 hours per unit. Okay, so they're the same in this example, but not necessarily the same in other examples. So for each unit that you need to produce, it's going to take 2 hours of labor. So we take the number of units we need to produce, we multiply it by the number of hours it takes to produce it, and we come up with our total required direct labor hours, right? No beginning ending inventory. We don't inventory labor. We already said that. So once we know how many hours are going to need to be worked in order to establish the cost, all we need is the cost of labor per hour. And we multiply the number of labor hours that we have times the cost per labor hour to get our total direct labor cost. And we get our total direct labor cost per quarter, and we get it for the year as well. And that's our second product cost budget. So we have done our direct materials. We've done our direct labor. The third one is the manufacturing overhead. Remember, manufacturing overhead is our kind of bucket all category. It includes everything else, right? It includes indirect materials, it includes indirect labor, it includes um, all of the costs that are associated with that factory or with the manufacturing plant. So all of those other costs, it kind of catches all the costs that aren't direct labor or direct materials, but are associated with the production of the unit. So the manufacturing overhead budget includes all of these costs. But it is important to know that it establishes or distinguishes between what's fixed costs and what are variable costs. And so remember, fixed costs are those costs that don't change based on production, and variable costs are the costs that do change based on production. So the variable cost per unit doesn't change, but the total variable cost increases as the number of units increase, the number of units produced increase. And the fixed cost, the total fixed cost doesn't change, but the fixed cost per unit decreases as production increases because the fixed costs are spread over more units. So when we're looking at a manufacturing overhead budget, it's important for us to distinguish between what's fixed and what's variable. And so those costs will be given to us, right? The variable costs will have, indirect materials costs, we'll have indirect labor costs, we may have utilities, maintenance costs, which vary with regards to the number of units produced. Now, in this case, they've told us that the expected variable costs are per direct labor hour. So the driver, that cost driver is the direct labor hour. So then we put together our manufacturing overhead budget. And you'll notice that our manufacturing overhead budget looks a little bit more complicated than our other budgets. Right? There's more to it because there's more costs. Direct materials, there's just the material cost, the direct material cost. Direct labor, there's just the direct labor cost. But in the manufacturing budget, the overhead budget, of course, we've got all of our indirect costs, both variable and fixed. So we have indirect material, indirect labor, we have all of our other overhead costs, and they're here. And so you can see, and this would vary by company, obviously, in the number of costs that they had, but the variable costs are there. The indirect materials is $1 per direct labor hour. So the dollar is multiplied by the number of direct labor hours, and the direct labor hours come off the direct labor budget. So you can see the total required direct labor hours, 6,200 in quarter one, 7,200 in quarter two, 8,200 in quarter three, and 9,200 in quarter four. Those are the numbers that are being used with the variable cost. So the dollar per direct labor hour, 6,200 hours. So it was 6,200 hours times $1. It was 7,200 hours times $1. 8,200 hours times $1. 9,200 hours times $1 to get those indirect material costs. My indirect labor was $1.40 per direct labor hour. So again, I'm taking the 6,200 hours and multiplying it by $1.40 for quarter one. Taking the 7,200 hours and multiplying it by $1.40 in quarter two. I'm taking the 8,200 hours and multiplying it by $1.40 for quarter three. And then, of course, the 9,200 hours and multiplying it by $1.40 for quarter four. My utilities and my maintenance also calculated based on the number of direct labor hours budgeted. So again, utilities, 40 cents per direct labor hour. So 6,200 times 40 cents. And my maintenance was 20 cents. So 6,200 times 20 cents. And I do that for every quarter. What that gives me is a total variable cost per quarter. And then, of course, for the year when I add it up. My fixed costs are those costs that aren't going to change based on the number of units that I produce. And what I'm assuming here is that my fixed costs are assumed to occur kind of continually throughout the year. So you can see that they give us fixed costs of 80,000. I'm just dividing it by 4. My amortization for salaries. amortization, 15,200 for the year, I'm dividing it by 4. So it's coming constantly at the same amount for each period. That may or may not be the case. I mean, for amortization, as long as it's straight line, we would assume that's the case. Salaries, we would assume, because salaries are usually annual, so we just divide it equally. Property tax and insurance, same kind of idea. Maintenance may fluctuate, right? We may have one quarter that's higher than another. In fixed costs, just because of the way that we book our maintenance, right? So anyway, those costs don't necessarily have to be the same for each quarter, but in this case they are. And then what we do is we add up our total fixed costs. And we add those fixed costs to our variable costs to come up with our total manufacturing overhead. Sorry, these slides are that's kind of whited out. But our total overhead for quarter 1 is 50,100. Our overhead for quarter 2, that should read 60,100. Our overhead for quarter 3, 63,100, and our overhead for quarter 4 should read 66,100. Okay. So notice that total overhead is fluctuating because our variable costs fluctuated on a per quarter basis. Our total overhead for the year is 246,400. Now what we do is we break it down a little bit here to determine what the overhead rate per direct labor hour is. So each month you can see there what's in blue. We have the total direct labor hours per quarter, not per month, but per quarter, for a total direct labor hours for the year of 30,800. So we just take our total manufacturing overhead, estimated or budgeted, divided by our total estimated number of direct labor hours to get our manufacturing overhead rate. And if you recall back to chapter 3, that was known as our POOR, our predetermined overhead rate. It would have been $8 per direct labor hour. So that's our overhead budget. So again, just to kind of review where we've come, we started at our sales budget, right, which was driven by our sales forecast. We moved into, that kind of drove our production budget. And then our production budget was divvied up between our direct materials budget, our direct labor budget, and our overhead budget. The next budget that we look at is our selling and administrative budget. So these are our period costs, right? We've looked at our 3 product costs. We now have to look at our period costs. Remember, our period costs are those costs that aren't related to the product. They're selling costs or they're general and administrative costs. And we have to anticipate what those operating expenses will be. We're again going to, similar to our manufacturing overhead budget, we are going to distinguish between what's fixed and what's variable. Okay, so our fixed costs, again, will be assumed to be the same every quarter. Our variable costs, things like sales commission or freight out, which is really delivery expense, will be based on the number of units that we sell, which makes sense. So our manufacturing overhead, some of our variable costs are based on the units. I mean, they were based on direct labor hours, but those direct labor hours are based on the units that we produce. In our selling and admin budget, our variable costs are likely based on the items that we sell. Okay, so our sales commissions, $3 a unit. Our freight out, our delivery expense really is $1 a unit. And so then we create our selling and administrative budget, which looks very similar, sort of, to our manufacturing overhead budget, right? We have our variable costs, and we have our fixed costs, and then we have total. So again, my sales commissions and my freight out is based on a per unit of sales. So the sales units came from my sales budget. 3,000 units in quarter 1, 3,500 units projected in quarter 2, 4,000 units projected to be sold in quarter 3, 4,500 units projected to be sold in quarter 4. Sales commissions, $3 times 3,000 units for quarter one, $3 times 35 units for quarter two, $3 times 4,000 units for quarter three, $3 times 4,500 units for quarter four. So that's how I calculate my variable costs. You can see the different types of fixed costs I have there: advertising, sales salaries, office salaries, amortization. That would be amortization on the office building, whereas my overhead would have been amortization on the factory. Property taxes and insurance, again, on the office building. And we've just assumed these fixed costs are constant throughout the year or incurred kind of continuously throughout the year. And again, that might be different. You might have fixed costs for advertising, but your advertising might be spaced out a little differently. So we add up our total variable costs, we add up our total fixed costs to come up with total selling and admin expenses. Where we end up now is we end up at a place where we're prepared to actually put together our budgeted income statement, which is really the last operating budget that we'll put together, right? So we've worked our way from the top through the sales budget, then the production budget, the direct materials budget, the direct labor budget, the manufacturing overhead budget, working our way to the selling and administrative budget, and the final operating budget we want to take a look at is the budgeted income statement. So the budgeted income statement is the end product of the operating budgets. And really what the budget income statement is supposed to do is indicate the expected profitability of the operations for the budget period, right? It's going to be the basis for evaluating the company performance. Okay, so we've walked through all the other operating budgets. We end up at our budgeted income statement. And really that we talked about, the evaluation of the budget to actual for performance indicators. This is the budgeted income statement is your basis for evaluating the actual performance for the company. You might use your individual budgets on a departmental basis, but this is the one for the entire company. And the budgeted income statement can't be prepared earlier than now. And by that I mean you have to have all those other operating budgets prepared first. So they're listed there, and we've just spent quite a bit of time going through each of them. But your income statement is a consolidation of all of those operating budgets. And so we're going to walk through what that actually looks like. So as you know, an income statement is going to include sales. It's going to include cost of goods sold, gross profit, obviously, and then work into your selling and administrative costs. Before taking a look at your income from operations, we also are going to need to be aware of any interest expense or any income taxes that we are anticipating. So one of the things that we don't have together as yet is the cost of goods sold, right? We do know the individual costs, and so we start with that. Okay, and this refers you back to some of the slides that we've already looked at. But our direct materials cost was $4 a unit, and we know that for each unit we needed 2 kilograms of material, of direct material. So remembering back to the earlier chapters when we looked at unit costs and product costs, we want to include our direct materials, our direct labor, and our overhead. So our direct materials, again, $4 per kilogram. Each unit needs 2 kilograms, so that's a total cost per product of $8. For direct labor, remember back to when we looked at our direct labor budget, it was $10 per direct labor hour. And we need 2 hours for each of those units as well. So that's $10 times 2. So we need $20 of direct labor for each unit that we produce. And then lastly, we have the overhead component. And if you remember back to the overhead budget, and I think I'll just flip back there for a second. The overhead budget, we broke it down at the very bottom on a per direct labor hour basis. So we saw that it was $8 per direct labor hour. And we know that each unit is taking 2 hours to build, 2 hours of direct labor hours. So 2 hours times $8 per direct labor hour gives me a total manufacturing overhead per unit of $16. And so we add those three costs up, our three product costs up to get a total unit cost of $44. Of course, our cost of goods sold will be determined by multiplying the number of units that we sell times that cost. And the number of units that we sell goes back to the sales budget, right? The sales forecast. And so if I was to go up all the way to the sales budget, and while I go back up here for a second to show you where it's coming from, the sales budget estimated by quarter for the year was a total of 15,000 units. So those 15,000 units are the units that we estimate for sales. So we estimate the cost of goods sold. We take those 15,000 units, multiply it by the total unit product cost of $44, and we get cost of goods sold of $660,000. And now we can start to accumulate our income statement. We take our information from the sales budget, which if you had looked when I just went back there, the 15,000 units at the sales dollars, estimated sales dollars, the total sales dollars were 900,000. Here's my budgeted income statement. My $900,000 comes from the sales budget. My cost of goods sold, I just calculated on the slide before, the 15,000 units that I'm selling times the $44 cost gives me my gross profit. This, of course, is a simplified income statement. It's not broken out in a lot of detail, but my gross profit is $240,000. My selling and administrative expenses come next, and that came from my selling and administrative budget. The total of 180 there, and I'm going to flip back up and show you where that came from, is my total selling and admin expenses. Okay, so my 180,000 is my selling and admin costs that I'm going to see on my income statement. So I get income from operations of $60,000. So notice if I walk back through my operating budgets, my sales budget appears on the top line in my income statement budget. My cost of goods sold, I calculated by using my production budget, right? The number of units I had to produce, or sorry, not the number of units I had to produce. I calculated using the number of units I was going to sell. So the 15,000 came from my sales budget times the cost per unit. And that cost per unit was derived from the direct materials budget, the direct labor budget, and the overhead budget. And all three of those budgets, the direct materials, the direct labor, and the overhead budgets, came from the production budget. So those budgets are related, interrelated, and they give us the $44 that we use to calculate the cost of goods sold. That gave us our gross profit. Sales minus cost of goods sold, gross profit, minus our selling and admin expenses, gives us our income from operations. Now, after our income from operations, typically we have things like interest expense or interest revenue and income tax expense. So those things are also going to have to be estimated and budgeted or anticipated and numbers given to you. So we have interest expense here estimated at $100 and income taxes estimated at $12,000. Plunk that into our income statement and we end up with a budgeted net income of $47,900. Okay, so that's our budgeted income statement. So that's the last of our operating budgets. The other budgets, if you recall back to when we looked at the master budget, are our financial budgets. And our financial budgets consist of three different budgets that we'll talk about. The cash budget, the capital expenditure budget, and the budgeted balance sheet. Those are our financial budgets that we're going to move into now. So first, let's talk about the cash budget. Now, the cash budget is a budget that most of you probably have already seen. And so you know what it is. You're familiar with this budget. It shows you the anticipated cash flows. So we're going to talk about it again, and so it'll be a little bit of review for many of you. But it is one of the most important budgets when we talk about the overall budget, the overall master budget. One of the most important budgets is the cash budget because cash is important right? Without the cash, we can't pay our bills. And so eventually we run into problems if we don't have cash. So accounting is based on accrual-based account, like we do accrual-based accounting, we teach you accrual-based accounting, but cash is very important. And so our cash budget, you're familiar with, really deals with three different sections. The cash receipts, so that's the cash, of course, coming in the door. Our cash disbursements, which of course is the cash going out the door, and then any financing. And the financing, you'll recall from finance, is really the finance point of view was, what do we need to be able to finance, and how do we finance our operations? So in our cash budget, we look at, what is our shortfall, or is there a shortfall? We look at the receipts coming in, we look at the disbursements going out, and then we see if there's a difference. Right? So we are looking at our beginning cash balances, we're looking at our ending cash balances, our inflows and outflows throughout the time period, and then of course any financing if it's required. So the basic format looks like this. Beginning cash balance, add our cash flow in, which are our receipts, add our cash in. That's our total available cash, of course, that we have for the period of time that we're looking at. We take away the cash that we are going to be dispersing, and the difference is either an excess or a deficiency. Right? We either have too much or not enough. And so if we don't have enough, we have to look at financing. Of course, that's the finance side of things. And then we have an ending cash balance. So this is what our cash budget looks like, and this is what we'll walk through, following in the example that we've been looking at for this chapter. As review, you guys are familiar with what are in our cash receipts, right? Lots of different things included in our cash receipts. This is, where do we get our money? Where does our cash come from? Usually cash sales or the collection of credit sales. That's the customers that bought on credit that are now paying off their accounts. So that's where most of our cash comes from. We can have cash from other places. We might have cash that we're getting from interest. Maybe we have a little bit of rent income on the side. Dividends are paid out sometimes in cash. We might have that. Maybe we sell some of our assets. So we have a cash inflow from, a sale of investments or sale of some of our capital, our property or plant or equipment, or some of sale from stock. Maybe we've sold some of our shares and we have cash inflow from that sale. Our cash disbursement section, of course, is anything where our cash is going out. Cash can come out or go out for materials, can go out for labor, can go out for overhead. So if you think back through those operating budgets that we looked at the production budget, right? Anytime we're producing units, we've got cash flowing out of the company. So direct materials, direct labor, the overhead for those products, and then selling and administrative expenses as well, when we pay the cash for that. We may have cash for going out the door for dividends. We have cash for capital expenditures, right? And we talked about the fact that that's a separate budget, looking at the capital expenditures that are going to be required for the period of time. So we have our cash inflow, we have our cash outflow, and then we have financing. And that financing just shows our expected borrowings or repayments of principal, plus any interest that we might incur on those borrowings. Now, you'll remember that when we prepare our cash budget, we got to prepare it in sequence, meaning that we've got to do it in order of in time. And just because our beginning cash balance, we have to start with a beginning cash balance. And our beginning cash balance of one period is the ending cash balance of the last period. So we need to know that information. We also need to know the information from the other budgets, right? We need to know what our sales budget is in order to look at our cash received on sales. We need to know what our direct materials budget is and know how we pay that in order to look at our cash disbursements for direct materials. We need to know our direct labor budget and how we pay for our labor. when we look at our cash disbursements. We also need to know about overhead and selling and administrative expenses, and when the cash goes out the door for those types of expenses as well. So we need to get information from all the other budgets, and we need to get information from management on any additional things that we might need to know. What's the balance we should keep in our account? Um, what's the interest rate if we have to borrow? Different things we might need to know. And often we prepare this cash budget on a monthly basis, right? A year is a long time, so we might prepare it on a monthly basis. We might prepare it for the year and then break it down into months. We also might break it down into quarters. Anyway, we're going to prepare the cash budget and look at the cash budget for the company that we've been working through. And so we need to know some more information, right? More information than what we have just from the budgets that we've already prepared. So here's our additional information. And this is just really regarding how the cash flow is happening. Right, so our cash balance at the beginning of the year, which we need to start with, is our $38,000. And then it tells us how we're going to collect the cash, right? How the sales on credit are going to be collected. So we're going to collect 60% in the quarter that we sell it, and 40% in the next quarter. Okay, so then it gives you, collect $60,000 in accounts receivable at December 31st, 2004. That shouldn't say 2004. Should say 2009. Say the collect $60,000 in accounts receivable at December 31st, 2009 in quarter one, right? And then the expected sale of short-term investments is $2,000 in quarter one. Direct materials, you can see here as well. Pay 50% in quarter purchased and 50% in the next quarter. Okay, and again, pay $10,600 in accounts payable at December 31st, 2008. Quarter one. And actually, sorry, I should go back. That collects $60,000 in accounts receivable at December 31st, 2004. It should say 2008, right? We're going to, basically what was there at the end of the year, we're looking at the year 2009. What was there at the end of the year 2008 will be paid. We will collect 60,000 of it in quarter one of 2009. And then for the direct materials, we're going to actually pay $10,600 of what was in our accounts payable at the end of the year. We're going to pay that in quarter one. And then we have our direct labor, and you can see here we pay it all as it's incurred. Okay, so it's all paid within the quarter that it's incurred. And we use this information to put into our cash budget in those sections of cash inflow versus cash outflow. So more information that we need, again, because we've talked about, or let me back up for a second, we talked about our sales, when we're going to collect our sales, that's cash inflow. And then of course we've got to work through when we pay our materials, when we pay our labor, when we pay our overhead, when we pay our selling and admin expenses. So that's what we're including. Now, right, our overhead and selling and admin expenses, we're paying them in the quarter incurred. It says except for amortization. And of course, remember, amortization is not a cash entry. No cash associated with amortization. Amortization is only a book entry. We do it to recognize the cost of an asset over its useful life, but it doesn't involve any cash flow. So we don't include amortization in our cash budget. Expected purchase of truck. This probably would come off your capital expenditures budget, but we're given the information here. So in quarter two, we need $10,000 to purchase a truck. We have our annual income taxes, and this is how we're going to pay them. We're going to pay them each quarter. And then any loans, any financing that we might need for loans, we'll pay them as soon as we can. Basically, it says pay in earliest quarter with sufficient cash. And that just means if you have more than $15,000, which is your minimum required balance, if you have more than $15,000, then you would pay back, you will repay some of your loan. All right, so again, most of this is review for you, but your cash budget usually involves a schedule of collections and then a schedule of disbursements. So your schedule of collections from customers is based on how you were going to receive the collections. And we just looked at the fact that you're going to receive 60% in the quarter sold and 40% in the next quarter. So the first quarter, and then we had accounts receivable of 60,000 at the end of December, and that was going to be collected in quarter one. So your 60,000 is going to be collected in quarter one, and then in your first quarter, you're collecting 60% of the amount sold. Now, if you went back up to your sales budget, you would discover that your sales budget was $180,000 for the first quarter. Okay, so if you went back up and took a look at your sales budget, the total sales for the quarter was expected to be $180,000. We are going to collect 60% of that this quarter and 40% of it next quarter. So 60% times 180 is your 108,000, and 40% times your 180 is your 72,000. In quarter two, our expected sales is 210,000, and again, that comes from the sales budget. So we take our sales budget, multiply it by 60%, we get 126,000. We take our sales budget of 210,000, multiply it by 40%, that will be collected in quarter three. So that's the 84,000. And we do this for each quarter. So in third quarter, we have budgeted sales of 240,000, 60% to be collected in quarter three, and 40% to be collected in quarter four. And lastly, my fourth quarter budgeted sales is 270,000. So I have 162,000 I'm budgeting to receive in quarter four, and the rest of it will be received in quarter one of the following year. So I add up my quarters, and I get my total collections per quarter. We then prepare the schedule of cash payments for direct materials, right? Because direct materials is also paid not all in the same quarter. So the information we had said that direct materials, we pay 50% in the quarter purchased and 50% in the next quarter. So again, my first quarter of 25,200 there, that comes from the direct materials budget. So if you were going back to your direct materials budget, we had the total cost of direct materials purchases in quarter one estimated to be 25,200. In quarter two, it's estimated to be 29,200. In quarter three, 33,200, and in quarter four, 37,200. So those are the numbers that are in brackets here. So these numbers come from the direct materials budget. We're given the information that 50% will be purchases will be paid this quarter, 50% next quarter. And so that you can see that split. Half of it is paid in this quarter, half of it is paid in next quarter. Our quarter two purchases, half is paid in this quarter, half is paid in next quarter. Quarter three purchases, half in this quarter three, half in quarter four, and my quarter four purchases, half in quarter four, the other half would be next quarter. And then I can add up what I will be paying out from my cash, or paying out for my direct materials in cash. The accounts payable, the 10,600, recall that was given to us. It said pay 10,600 in accounts payable in quarter one. So that number was given to us. So now we have our schedule of expected receipts from our customers. We have a schedule of expected cash payments for our direct materials. The payment for direct labor was in the quarter that it was incurred, so that's not that difficult. And so you'll see that added in your full complete budget. So here is your full completed cash budget. Notice again, we've got to prepare it in order. So quarter one's got to be prepared before quarter two, because the beginning cash balance in quarter two is my ending cash balance in quarter one. So I start with my beginning cash balance. This number was given to me. I add my collections from my customers. That is from the schedule of receipts that we just looked at, right? So that this line here, 168, 198, 228, and 258 comes from my schedule of collections, 168, 198, 228, 258. Right? That's where those collections are coming from. The sales of securities, this $2,000, came from the additional information that was given to us that said we expected to sell short-term investments of $2,000 in Q1. So let me go back up here and show you where that came from. Okay, so my sales I've dealt with, right, in my schedule of sales. My expected sale of short-term securities, $2,000 in Q1. So that's where that $2,000 is coming from. Okay, so there's my $2,000. Now I have total receipts, which is just the amount of money that I'm going to receive in the month, or in the quarter, sorry. My total available cash is the total amount of the receipts plus the beginning cash balance. 208,000 in Q1, 223,500 in Q2, 243 in Q3, and 277,400 in Q4. Now I look at my disbursements, and my disbursements include all those things that we talked about: our direct materials, our direct labor, our overhead, so the product costs, and then our period costs, and then other stuff. And the other stuff, I mean capital expenditures, income tax. So our direct materials, 23,000, 27,200, 23,200, 27,200, and 31,200. Those numbers are coming from the schedule here of cash payments for direct materials, because my direct materials are paid 50% this quarter, 50% next quarter. So you can follow through there: 23,200, 27,200, 31,200, 35,200. Those total payments now are seen on your cash budget right here. My direct labor dollars come from my direct labor budget. And remember, it told us that all of my direct labor is paid in the period that it's incurred. So those numbers come directly from my direct labor budget. So I'm going to go back up here so that you can see where it came from. I have to go back up quite a bit. And here's my direct labor budget. See my direct labor costs: 62,000, 72,000, 82,000, 92,000. And those numbers are now appearing in my budgeted income statement under my budgeted labor. And while I'm here, let's look at our overhead as well. My total manufacturing overhead, that's going to carry through to my budgeted income statement as well, because it's also paid in the quarter that it's incurred, except for amortization. So these numbers won't tie in exactly. My total manufacturing overhead won't tie in exactly to my income or to my cash budget because of the amortization. So let's go back to our cash budget. Okay, almost there. So when you're looking at it, here's my direct materials, here's my direct labor. Notice my manufacturing overhead. It doesn't tie in exactly because what I've done is I've removed out the amortization. So the numbers that we looked at when you looked at our overhead was $57,100. And what I've done is taken out the $3,800 of amortization. You can see it here in the footnote. And I've done that for every quarter. So in Q2, the total manufacturing overhead was $60,100, and I've removed out the $3,800 in amortization. I did that for Q3 and also for Q4. My selling and administrative expenses, I'm doing the same thing. Again, I was told that my selling and admin are paid in the same month that they're incurred, same quarter that they're incurred, except for amortization. So if you went back to your selling and administrative budget, you would see that the total selling and admin expenses for Q1 was $42,000, but there was amortization of $1,000. So we removed the amortization. Remember, amortization is not a cash expense, not a cash cost. It's just a book entry. And we do that, we remove the amortization of $1,000 from each quarter. So on the selling and admin budget, we had total expenses of $44,000 for Q2, and you can see on the cash budget we have $43,000. 44,000 minus the 1,000 is 43. For Q4, we had total expenses of 46,000 minus the 1,000. For amortization is 45,000. Okay, so I'm now taking all the information from my budgets and putting it into the cash budget. So I've looked at the sales budget, I've looked at and the schedule of collections from that sales budget. I've looked at my direct materials and the schedule of payment related to my direct materials. I've looked at my direct labor. I've looked at my overhead, and I've now looked at my selling and admin expenses. Now for other costs that I'm going to incur. I have my income tax expense, and that comes from my income statement, right? The income statement told me what my income tax expense was going to be. Now the additional information that I had told me that it was going to be paid quarterly, right? It was going to be paid in equal payments each quarter, and so that's why I took the 12,000 and divided it by 4 to get 3,000 each quarter. My purchase of my truck was some additional information that would have come from a capital expenditure budget, and that was just saying that I'm going to purchase a truck for cash in quarter 2. So I put in my $10,000 for that purchase. I then have all of my disbursements, right? I've got all my disbursements, my materials, labor, overhead, selling and admin, the truck, the income taxes, and I add them all up. And I have my total disbursements. And I can then calculate my excess or my deficiency of cash over disbursements, right? The cash coming in versus the cash going out. So I have my total available cash. So in quarter 1, 208,000 minus 182,500. I have excess cash of 25,500. Quarter 2, and notice here, sorry, let me finish this off. So I don't need any financing because I have over $15,000 in my account. My ending cash balance is 25,500. That becomes my beginning cash balance. And then I can do the same thing, add in my available cash, subtract my total disbursements. So 223,500 minus 211,500, I get $12,000. Now I'm short. My minimum cash balance is $15,000. I need to borrow $3,000. So I borrow $3,000. And I can put that in my borrowings. And so I have a minimum balance of $15,000 at the end of the month, which I then take to my opening cash, my beginning cash. Right, add in my total receipts, I get total cash available. Subtract out my total disbursements, I get excess cash of $22,500. And remember that it said for loans, I pay it back in the earliest quarter that I can, as long as I exceed the $15,000, and I do. I exceed the $15,000, so I can pay back my loan with interest. So I pay it back with interest, $3,100, and I have ending cash balance of $19,400. And I do it again for quarter 4. And I follow it through. And so that is the cash budget. Right? Very useful in terms of helping managers figure out when cash is coming in, when cash is going out, when we might need to borrow. And so really the cash budget, what it does is helps contribute to more effective cash management. Right? Lets us know when we will have excess cash. So if we look at this budget in quarter 1 and quarter 4, we have excess cash. We need to determine what we do with that excess cash. And we talked more about that, or you saw that more when you did your Finance 2 course, and what do you do with extra cash, and whether you invest it or whether you purchase things is a different management decision. The last budget we really need to look at is the budgeted balance sheet. We're not going to really spend any time on the budget of capital expenditures because you can see that the budget of capital expenditures, the cash going out for that will also flow into the cash budget. So all you really need to know about the budget for capital expenditures is that it's a separate budget that just looks at when major capital expenditures will need to be purchased. Okay, so the last one we really want to take a look at is the budgeted balance sheet. The budgeted balance sheet is really a projection of what the financial position will be at the end of the budget period. It's developed from the budgeted balance sheet for the preceding year and then from the budgets that we've just finished looking at for the current year. Of course, with some additional data that you need. So we're given Here we're given, what our buildings and equipment are, what the accumulated amortization is, our common shares and our retained earnings. So we're given some of the information from the equity section of the balance sheet. The rest of the balance sheet comes from some of the budgets that we've just finished looking at. So the cash, for example, as we walk through them in our asset side, the cash is from the ending cash balance on our cash budget. So if you went back to the cash budget and took a look, you would see that the ending cash balance is $37,900. So that's where our cash budget, our budgeted cash comes from. The accounts receivable, you would notice, comes from our schedule of expected collections from customers. It's 40% of the fourth quarter sales of $270,000. That's the $108,000. So that's coming from that schedule of collections. The finished goods inventory is really coming from the production budget. Remember the desired ending inventory that we had of 1,000 units in the production budget, and then we multiplied it by the cost per unit, which we determined to be $44. And as you work back through the budget, you'll see that the $44, of course, was a combination of the direct materials per unit, the direct labor per unit, and the overhead per unit. So the $44 per unit multiplied by what our ending inventory is budgeted to be of 1,000 units gives us our finished goods inventory. The raw materials inventory balance comes from the direct materials budget. And again, remember, in the direct materials budget, we had desired ending inventory of 1,020 kilograms. And so we took that desired ending inventory and we multiply it by the cost per kilogram, which was $4. So our ending or budgeted raw materials inventory for the year is $4,080. Buildings and equipment, you notice the additional data they gave us was $182,000, and yet we've got budget of $192,000. And that's because we've taken the $182,000 and added on the budgeted capital expenditure of $10,000. So that gives us the $192,000 in buildings and equipment. As for the accumulated amortization, we see that we're starting with $28,800, but then we need to add the amortization or the depreciation that's budgeted for the year. So we get that from the overhead budget and from the selling and administrative budget. So we had $15,200 from depreciation budgeted in the manufacturing overhead budget, and we have $4,000 depreciation budgeted in the selling and administrative budget. So when we add that to the accumulated amortization from the last balance sheet of $28,800, we get a balance of $48,000. That all added together gives us the budgeted total asset number. Our accounts payable number comes from 50% of the fourth quarter purchases. And if you go back to the schedule of expected payments for direct materials, you'll see that the fourth quarter purchases of $37,200, the 50% of that is at $18,600. We have no information to change the common shares, so you'll notice the common shares are the same, but the retained earnings is different. And the retained earnings is calculated by taking that $46,480, which would have been last year's balance, and adding in the budgeted net income, which we saw on the budgeted income statement. So the budgeted net income was $47,900. So we're adding that in to our retained earnings. And then you can see that what we have here is a budgeted balance sheet, and it balances. Now, once the company has done all of their budgets, once the master budget is done and they've looked at their operating budgets and they've looked at their financial budgets, what the company will do is usually do a sensitivity analysis, right? So they manipulate the budgets to change things. What if sales increase? What if sales goes down? What's the impact on production? What's the impact on the financing needs? And this is easy to do when you have computer programs that support it. So as all of these numbers are calculated and inputted, then they can be manipulated to see, the sensitivity to certain items and do some different what-if scenarios. So it's very, very important in a business to have some kind of software to enable you to do that with your budgeting. And you'll notice that Excel is used widely, and there's other budgeting softwares out there as well. Now, we spent most of our time looking at the budget, looking at a master budget for a manufacturing company. It's also an important process in merchandisers. And so in a merchandising firm, they also take a look at their operating budgets and their financial budgets. And it's critical, right? It's critical not so much in determining direct materials because they don't have that, but in determining their inventory, how much inventory they need to have on hand. So with determining how much inventory they need to have on hand, what they do is they take their budgeted cost of goods sold, they add in what their desired ending inventory is, subtract out their beginning ending inventory, end up with a calculated number for what they're required to purchase. And you can walk through an example in the textbook of just looking at a budget for what the required purchases would be. It's also critical to budget in service companies. So service companies don't really have an inventory because they're not a manufacturer, they're not a merchandiser, they're focused on providing services. But the services that they're providing need people. And if they're going to provide enough services, they need enough people to provide it. And so it's critical to budget to determine what the level of staffing is that is required. We have to be able to, those companies have to be able to coordinate their professional staff needs with the anticipated services that they're going to provide. If they overstaff, then what happens is they have labor costs that are very, very high, which means in turn that they will have lower profits because they're paying too much in salaries. If they will also have, they may also incur increased staff turnover. If they're overstaffed, professional staff tend to get not challenged, they tend to get bored, and if there's nothing for them to do, they will look elsewhere, and they may end up leaving. If they're understaffed, then you have another problem. If they're understaffed, you may lose revenue because you can't provide the services that clients want, right? You don't have the staff there to provide the services in a timely fashion. The other issue you might run into is if staff are overly worked or they're being excessively worked, they sometimes end up not being happy, and the turnover will happen again as staff go to other places where they can be a reasonable workload. So service companies also need to budget. Nonprofit companies also are budgeting. They budget a little different because it's not a profit-oriented, right? It's a non-profit oriented, so they're budgeting on the basis of cash flows, and we call them expenditures and receipts. And they're not looking at revenues and expenses. And so what they start with is they start with the expenditures, right? They budget their expenditures and then determine what the receipts are that they require. So it's significantly different than the budgets that we've looked at in this chapter. So the focus on this chapter really is the master budget, making sure that you understand that it is driven, the sales budget drives the other budgets. The sales budget is driven by the sales forecast, which is driven by a number of different factors. Once the sales budget is completed, it drives the production budget, again, which is the direct materials, but production budget drives the direct materials budget, the direct labor budget, the overhead budget, manufacturing overhead budget. We also need to take a look at the selling and administrative budget, which then all roll into a budgeted income statement. And then to look at the operating budgets, we look at our cash budget, the budgeted balance sheet, as well as the budgeted for capital expenditures. And so as you're walking through this chapter and as you're reading through the chapter, make sure that you understand how the budgets are interrelated and how that they are actually prepared. What I want to do just at the end here is just do one quick example, and not of all the budgets, because I've walked you through all the budgets, and you will do, do some examples as you work through the tutorial questions. And as you work through them, just kind of on the side, there are 3 tutorial questions. One actually walks you through the selling and administrative expenses budget, and then the other 2 walk you through a cash budget. And as you know from me walking through everything here, that a cash budget, in order to prepare the cash budget, you have to prepare all the additional budgets kind of along the way. So in those 2 other questions, you'll look at The receipts and the collections and beginning cash and closing cash and schedules of the collections and receipts. You'll also look at production and required production. So you'll see that as you walk through the other tutorial questions. But the one I just want to do relatively quickly is exercise 10-26. And it's just looking at a budgeted income statement for the year. So just a simple income statement. It doesn't give us a lot of information. It tells us what the sales is, and as we know, we need to know that what our sales forecast is in order to produce our sales budget. That will drive our other numbers. And so if you look at 10-26 on page 454, this company has accumulated some budget data for the year 2012. We have our sales of 30,000 units, anticipated selling price of $80 a unit. We have the cost of 1 unit of finished goods. So there you go. With the product costs, we have our direct materials budgeted at 2 kilograms at $5 per kilogram for each unit. Direct labor budgeted at 3 hours for each unit at $12 an hour. And then lastly, the overhead budgeted at $6 per direct labor hour. So that gives us the information we need to calculate our cost of goods sold. We're given our inventories, our raw materials inventory, the beginning inventory and the ending inventory. Notice the beginning and ending inventory aren't in costs, but they're in units, right? They're in kilograms, not units, but they're in kilograms in weight. The raw materials cost is $5 a kilogram. And then they give us the selling and administrative expenses of $200,000 as well as income taxes of 30%. They ask us to prepare a schedule of cost of goods sold as well as a budgeted income statement. Okay, so let's walk through this quickly. I've shown you the solution here, but the cost of goods sold section, you'll remember, is based on the 3 different product costs. So we need to know the number of units that we're planning on selling, the anticipated sales, and we need to know the costs, the 3 different product costs, the direct materials, the direct labor, and the overhead. And so we were given this information. We were told that each unit takes 2 kilograms of direct materials, and each kilogram is $5. So 2 kilograms times $5, that means our direct materials cost per unit will be $10. Our direct labor, we were told, is 3 hours for each unit, $12 an hour. So again, 3 hours times $12 is $36 per unit for direct labor. And then our overhead is based on our direct labor. And it said that it's $6 per direct labor hour. Well, there's 3 direct labor hours required for each unit. So 3 times 6 is $18 in overhead, estimated overhead for each unit. So the cost of 1 unit to finish, or the cost of 1 unit of finished goods, is those 3 costs added together, which is $64. We're anticipating sales of 30,000 units, which means that $64 times 30,000 is the cost of goods sold, estimated or budgeted cost of goods sold of $1,920,000. This gives us the information that we need for the cost of goods sold on our budgeted income statement. So when we look at our budgeted income statement, of course, we start off with sales. And our sales are budgeted to be 30,000 units, $80 a unit, $2.4 million in sales. Our cost of goods sold we had just calculated at $1,920,000. So our gross profit is $480,000. We can then put in our selling and administrative expenses, as well as estimate our income tax expense. Now, in this question, it didn't give us what our income tax expense was. It gave us a percentage and told us that income tax is estimated to be 30% of the income before taxes. So when we took our gross profit and subtracted out our selling and admin expenses, we ended up with income before income taxes of $280,000. And when we applied our income tax rate of 30% to that, we got income tax expense of approximately $84,000, which means that our budgeted net income for the year is $196,000. So we've been able to put this into a budgeted income statement fairly quickly with the information that we had. And again, I would encourage you to work through some of the problems at the back of the chapter, especially those ones that you'll look at in tutorial next week, as they will walk you through these budgets on a more detailed basis. So that's it. That's it for chapter 10. That's it for budgets. Enjoy your week, and I will see you next week on July 30th. I'll see you, and we'll talk about and start chapter 10 at that time.